I'm Tom Stelzer from Livewire Markets, and today I'm pleased to be joined by Chris Joye to talk about Coolabah Capital's Global Floating Rate High Yield Complex ETF, or YLDX. Thanks for joining us, Chris.
Thanks for having me, Tom.
If we could just start with a brief introduction to your firm and maybe what makes your investing approach unique.
Coolabah Capital Investments, we run just over $16 billion of global fixed income money. We have the largest team in the liquid investment grade bond market in Australia. So around 53 professionals in London, Miami, Auckland, Sydney and Melbourne. And that team includes 11 traders and 22 analysts. And we're also the most active trader of Aussie bonds globally. So we're typically buying and selling $500 million to $1 billion a day. And then finally, we have a very systematic or quantitative process. When trying to figure out what interest rate a bond should pay us, we apply up to 80 different quantitative techniques. Typically, we're using 10 to 20 models to price any given security, but we're really focused on only trading the most liquid bonds, the safest bonds in the world, and bonds that are mispriced, that have a little bit of extra interest rate juice, which can then provide us with a capital gain or some price appreciation. We're also very selective. So of the 7,000 investment grade bond issuers globally that exist, we only allocate capital to around 305 of those. So we kick out 96% of the total universe. However, those 305 are like the mega caps, the too big to fail, implicitly government guaranteed issuers, and they represent 55% of the entire bond market.
And what would you say is your current outlook for income investors looking at fixed income markets?
Current dynamics are very interesting because we have two influences. On the one hand, long-term interest rates have remained very high. We're very much in a high rates for long environment, which is an interesting juxtaposition to the low rates for long regime that applied in the post-GFC period. And then short-term interest rates, which are controlled by central banks, are still very high as well, but they're falling. So we are seeing central banks chisel down those rates. We don't expect big rate cuts. For example, here in Australia, the RBA probably has a couple more cuts left, but the terminal cash rate is going to be around 3%, much higher than the level that prevailed prior to the pandemic, which was less than 1%. Similarly, in the US, the Fed's at 4.25% to 4.5%. We think that will come down a little bit to somewhere between 3 and 4, but we're going to be left with high short-term interest rates and, crucially, very high long-term interest rates, because bond markets are focused on the fact that governments are issuing a lot of debt, and we bond bandits, so to speak, need to be paid handsome compensation or consideration to take down all of that debt. So the sheer quantum of debt being supplied globally is keeping long-term interest rates very high, and that means, to answer your question, that yields are likely to remain very attractive. The other little nuance here is that bond yields are much more attractive than equity yields. If we look at the major banks here in Australia, we study their equity valuations and their bond valuations, and normally major bank equities provide a forward total return that is about 6 to 6.5% per annum above the yield on their bonds. And today it's sitting at closer to 2 to 3%, that extra return premium on equities. On that basis, major bank equities look about 50% overvalued relative to their bonds. So bond yields are actually pretty attractive, particularly financial bond yields, not so much corporate bonds or high yield or other parts of the debt market.
And Coolabah Capital have recently launched the YLDX ETF. What's the opportunity you've identified there?
A few things. We, a couple of years ago, launched almost identical, very similar product called Floating Rate High Yield. And this was a normal managed fund. And that's almost $2 billion in size, but it's not available as an ETF. So our clients had said to us, we really want a listed or ETF version of Floating Rate High Yield. We also tweaked it. The Global Floating Rate High Yield Fund, which is the ETF version, and the ticker is, as you say, YLDX, YLDX has monthly income distributions rather than quarterly income distributions. And YLDX can allocate not just to Aussie bank bonds, which is the restriction on the original floating rate high yield fund, it can also allocate to global banks. So, Goldman Sachs, Morgan Stanley, JP Morgan, as well as ANZ, NAB, CBOE and Westpac. Most of the portfolio is Aussie bank bonds, the vast majority, as is obviously floating rate high yield. The other opportunity for investors that we were trying to resolve or present a compelling answer to is obviously the maturity, the pending maturity of the listed hybrid market, specifically the bank hybrid market. So there are about $40 billion of bank hybrids that will mature between now and 2032, and investors are going to lose that income. And so we wanted to provide a solution. So YLDX has a yield of 7% compared to the typical yield on a hybrid. A 5-year major bank hybrid is only yielding 5.7%. YLDX has a credit rating which basically signals the extent to which there's any default risk on the bonds in the portfolio. Its credit rating is A+, and it's much higher than major bank hybrid ratings, which are only BBB. YLDX holds bonds that are much more liquid than hybrids. It does use leverage, whereas hybrids are unlevered, but hybrids sit lower in the capital structure relative to our senior bonds and subordinated bonds. They're in YLDX. So hybrids are actually structurally leveraged relative to the assets in YLDX. So it's got a high credit rating. We would argue it's got better liquidity. It's definitely got a better yield. Over the last 12 months, this sector that YLDX invests in has returned about 8.2%, whereas the hybrid market's only done 6.5%. And we've also, over the last 12 months, seen that sector have about half the volatility of the hybrid market. So you're basically getting a better yield than hybrids. You're getting a better credit rating. You're getting better or lower underlying default risk. You're getting better liquidity. The risk of all investments is obviously, in the case of these securities, just mark-to-market volatility. It's not private debt. It's not high yield. These are A+ rated, super high grade, super liquid bonds. But the yield is very compelling at 7%. Floating rate high yield has been very, very popular, but it's not available in an ETF format.
I think you covered it pretty well there, but what would you say are the key features of the fund?
In fixed income, investors tend to look at yield as their main source of return. And the way to drive yield is through illiquidity. So you can go into private debt, you can go into high yield bonds that have no liquidity. You can also drive yield through default risk, again, by going into riskier parts of the debt market. We've seen huge blow-ups here in Australia with Virgin Airlines bonds, very popular listed bonds, yielding almost 8%, but they had 100% write-downs, basically. Another example is that those Credit Suisse hybrids. In 2022, they looked attractive, paying 10% yields, but in March 23, they were worthless, and unfortunately, many Aussie investors had exposure to Credit Suisse hybrids. So you can look at for illiquidity to drive yield, default risk, and then interest rate risk. At Coolabah, we try and in YLDX, we try and minimize all of those risks. So the portfolio is floating rate, so it really doesn't have anything like the liquidity risk of most investments. It's very liquid. The portfolio has a very high credit rating, that A+ rating, which means we've really minimized any default risks. And finally, it's floating rate, which means you're not making an assumption or betting on the direction of interest rate markets. The yield on the portfolio will go up and down with the RBA cash rate. And even after the RBA cash rate's fallen from 4.35% down to 3.6%, the yield on the portfolio has remained pretty compelling at circa 7%. So we think investors are being offered lots of opportunities that are alternatives to hybrids in the form of listed investment trusts that are typically allocating to high yield bonds or a liquid RMBS or private credit, and they may have a role in portfolios. But this is a very liquid, highly rated solution that is a very, very different and really unique proposition.
And what would you say your reception's been like since it's launched?
Very interesting. I think YLDX is, I believe, one of, if not the fastest growing active ETF in Australia. We obviously also run HBRD, which is the largest active ETF in Australia, 2.5 billion. We run that for BetaShares, who are the product owner. And HBRD is also growing quickly, but HBRD doesn't use any leverage, whereas YLDX does. So yeah, reception's been great. It's slowly being made available on more and more platforms, but most folks have access to the listed markets. So through any broker, they can access YLDX. So we're very pleased with both the performance, the returns thus far, and also the flows into the product.
And you obviously touched on the superior credit ratings there, but what would you say are some of the risks around the product?
In this portfolio, and I'd say all of our portfolios, we're trying to invest in bonds that really have de minimis or no default risk as far as we're concerned. So very highly rated, typically A to AA to AAA rated bonds. We're also very active. As I mentioned, we're buying and selling $500 million to $1 billion worth of bonds a day. We're the most active investor in the Aussie fixed income market, and we, as I mentioned, need the biggest team in the market to manage that activity. But with all these investments, the more liquidity you have, the more scope there is for some volatility, so variation in the unit prices, and that's the trade-off. I know my advisor in my portfolio has allocated some of our assets to illiquid funds, and just trying to take money out of those products is an absolute nightmare. So we needed some liquidity recently, and we redeemed out of 2 equity funds. One took 6 months, another took 12 months. We're redeeming out of a litigation fund, and that's going to take basically a year. So if you need liquidity, some of those high yielding opportunities are encumbered with a lot of illiquidity that can constrain your ability to move in and out. And then the other thing I find with illiquid assets, when they're listed, we tend to find that those listed investment trusts in a stress event can trade at very, very large discounts to their net asset values, as much as we saw in March 2020, 50% discounts to NAV. Whereas if you look at an ETF like, for example, HBRD, which we run for beta shares, during the March 2020 shock, it always traded at NAV or around NAV because the underlying assets, the bonds and hybrids, were very liquid and always traded. And so people didn't have concerns about, well, how are you valuing these assets? Because they could see them trade every day. In March 2020, there was, in the hybrid market alone, over 1.2 billion traded in the month. So there's no question about valuations. Whereas when you're dealing with illiquidity, you can have a lot of questions asked about valuations.
And finally, where can investors get more information about YLDX?
So obviously at coolabahcapital.com, you can find much more out about YLDX, but it should be available through all brokers and all good advisors.
Thanks for joining us today, Chris.
Thank you.
Thanks for tuning in. For more great videos like this, make sure to check out our YouTube channel.